welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank by applying the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sari Ibrahim. Today, I'm interviewing Karen Rands. Karen is a venture catalyst, a compassionate capitalist, economist, investor, and entrepreneur. She is nationally recognized as an expert on angel investing and the author of the best-selling book, Inside Secrets to Angel Investing. Karen is a leader and advocate for the compassionate capitalist movement. She believes entrepreneurism is the greatest source for wealth creation. She says you don't have to be a successful entrepreneur to create generational wealth if you can learn how to invest in those companies that have the potential to be the next big thing. Karen managed a traditional angel investor network in Atlanta, Georgia for many years until the Jobs Act of 2012 created an opportunity to disrupt the status quo for connecting entrepreneurs and investors. Karen offers capital strategy, preparation, and investor relation services for entrepreneurs seeking financing based on the new regulations for crowdfinance through her firm, Kugarand Capital Holdings LLC. Karen provides education and due diligence services to a new generation of private investors in her national network of angel investors. Karen Rands, welcome to our podcast.
Thank you so much. I'm so excited to be here, be back with you again, doing a podcast. This is great.
Yeah, thank you. Yeah, and for the audience knows I was on your podcast, I think like a year and a half, 2 years ago. So thanks for having me on your podcast. It was nice meeting you and getting to know your brand. And that's what I want to talk about today, a little bit more about what you're doing. So can you tell us more about your background and what you do?
I came out of the corporate world working for a big tech company, shepherding new innovation through the company to, for the company to basically embrace and help go to market. And through that, I discovered the world of private capital for businesses. And on one end, it was sort of like we would provide resources and services to help validate the company's technologies that were our clients, with the idea they would go out and get venture capital and then come back and spend it with IBM. When I left IBM at a very opportune time of January of 2000, and if you know what was going on in the market at that time, it was the really kind of like the beginning to the end. It was like right at the peak of the dot-com bomb. Mm-hmm. But me, myself, and I in my little bubble of IBM had no idea that was happening. So I left to go help one of my clients that had amazing technology go to market and bring, and get capital. And discovered the world of angel investing in that process when I was in the corporate world, as probably some of your listeners are be. Never heard of angel investing. I'd heard of venture capital, but I'd never heard of angel investing. I now call it the best kept secret, how the rich get richer.
Yeah.
Right. And discovered a couple of fundamental rules of what makes a good investment along with that particular experience, because this guy didn't have those attributes. And so called experience and attitude. As the product was great, but and so as I said, I discovered angel investing. I found this group, the Network of Business Angels and Investors. The founder of that group was looking to phase himself out and kind of retire. So he started mentoring me to take over that organization, which I did in about 2006 timeframe, rebuilt it to be one of the most active in the Southeast and the top 50 in the country, up until the Great Recession. And then the particular business model that we have for that angel investor just couldn't sustain through that. And I pivoted towards the new world order of direct public offerings, what most people refer to as crowdfunding, and helping really focusing, and with my book, Inside Secrets to Angel Investing, helping people that have heard of angel investing, have like this idea of, can I get into a private company, or what is this crowdfunding stuff, to figure out what they could be an angel investor, be an investor in entrepreneurs, and created the compassionate capitalist movement as a real emphasis, a passion to get more money into the marketplace for entrepreneur endeavors, to bring innovation to the market, create jobs, and create wealth for all those involved.
You mentioned a lot of really interesting things. I want to kind of like go back a little bit. So You mentioned like angel investing or being an angel investor, and then venture capital. So do you mind sharing with us, like for those who don't know, what is an angel investor?
So it's I can put it within the context of against venture capital
Uh-huh.
because most people have heard of venture capital. So venture capital is really when there's high net worth individuals or institutional money that have put their money into a fund, and it has a management team that analyzes the deals and invests in the deals, and it does all the investments. So venture capitalists are investing other people's money, and then not much different than like a hedge fund or
Yeah.
something like that, but in this case it's into private companies that have huge upside potential, buying wholesale, selling retail, before they go public or get bought.
Mhm.
So angel investors, the traditional angel investor fits in that gap where you can't go to the bank, or you're
Yeah.
not big enough or far enough along with venture capital, because typically venture capital have large amounts of money under management, and therefore they make larger investments because they don't want to manage $100,000-$200,000 investments. It's
Yeah.
much better to have $2 million investments, right? And so they so that's their place. Whereas angel investors, typically the traditional will invest between $25,000 and $50,000 in a single deal, and then over time build a portfolio of 10, 15, 20 companies that are phasing in and out as they go through that, if they're building a diversified portfolio of those. And so the biggest thing is that they're writing checks out of their own checking account. So it's
Yeah.
much more personal when it's angel investors. And most the traditional definition of an angel investor is somebody that's an accredited investor,
Uh-huh.
meaning that they have a certain level of wealth and accumulation of assets that qualify them for
Uh-huh.
that. And they and I can share that stuff, but it's basically it's enough to be where the government feels like they're smart enough and savvy enough business wise to recognize the inherent risk of a private company investment. And then now you have this kind of muddied water, if you will, because the world of crowdfunding or direct public offerings allows people to become an angel investor, or be an investor in private companies without that level of income. They just have to have a certain amount of discretionary income, and there's certain limits on how much they can invest if they can't prove that they're an accredited investor.
Gotcha. And then as far as crowdfunding, it's not only that they don't have to be accredited, but also the investment amounts are much less. They don't have to put 25 or $50,000. I think you can even do like some investments as little as like $100 or $500 into
For
some
sure.
crowdfunding. Yep.
Yeah. So, the crowdfunding came out of the Jobs Act, which
Mhm.
was in response. It was a bipartisan, I think like 98% of
Yeah.
Congress stuff voted for it. And it came out of as an economic stimulus strategy after the Great Recession. And the financial markets had collapsed. So on the one side, it was really hard for entrepreneurs to get bank loans and
Yeah.
various things like that. So most people think of the Jobs Act as a way for entrepreneurs to get access to capital. But the other side of the coin is that they also recognize that because of the collapse of the financial market and the real estate market, a lot of people's portfolios had completely
Yeah.
evaporated, their stock market portfolio and their real estate portfolio in the decline. And they, history proved, it took them 10 years to get back to zero, back to the baseline of where they were. And so what they saw was that with reward-based crowdfunding, there was a lot of technology that we take for granted today that came to market under reward-based, where people gave them money in
Yeah.
exchange for products, for rewards, right? So you had the original smartwatches,
Yeah.
drones, 3D printers, VR headsets, all these things, even the fidget widgets, they all came to market with people doing for products. So when those companies went on and raised tens of millions of capital from venture capitalists, sold those companies, those people that put in $500, let's say, or $50,000, whatever the case might be, because of the way they structured their
Mhm.
reward base, they received no benefit when that company went on, on a return on investment. So
Right.
the government I guess because they actually listened to a lot of the people in the marketplace, they realized that they needed to make it friendly for people to get involved and it not just be the rich get richer, that your average middle class person could participate, and your up and coming young people that already kind of understood reward based crowdfunding, and they don't have the means to do a $25,000 investment, but they could do $500 a month. And if they're starting out in their corporate careers, they're not going to get vested in their 401k for retirement for 5 years. But if they did that plan, they'd have a portfolio of what would that be? That would be what, 60 companies, over a 5-year period of time. And, you just basic math, even if you're bad at it, use the basic math, they're going to make a lot more than they would have in the money, the 30,000 they would have put in their 401k during that time.
Of course. Yeah. The 401k is going to have fees. And plus, I mean, how much could you really do in like index funds and mutual funds? You're not going to like multiply your money by like 10 times over 5 years. You could by investing into privately held companies. That is a possibility, right?
Yeah. The reason why people invest in entrepreneurs and what people are figuring out, it is the highest rate of return.
Yeah.
On average, about 4 times what you get from stock market and real estate market when you're, look at it over an annualized 10-year period of time.
I think one of like the biggest disadvantages, right, to investing in privately held companies is probably the lack of liquidity. So like right now, like today, I can go put money into a mutual fund, and then tomorrow I can like sell and take my money out, right? But in a privately held company, I can't go and invest like $10,000 into a privately held company and then tomorrow ask for that money back. It's typically an illiquid investment. But I think that's also a plus side too, because if everyone's able to take their money out of the investment, then it'll shrink the value of that investment. So in essence, by locking up the money for 5, 7, 8 years and then selling or going public, it assures that the company could handle those investments and they can contain those investments to go to the next stage or next level.
Yeah, they're filling the gap when the company doesn't have enough cash flow to get a loan that would make a pick, or they can't go to the VCs.
Yeah.
And it's a different type of, typically an investment model when you do any of the direct public offerings than it is under a traditional angel investor model, which goes through angel investor groups and things like that. So, one of the things we talk about in the book, though, just to your point, is that how you would decide how much you invest in a company and how much you're going to allocate depends on what the rest of your net worth is. And sometimes, or the way your liquidity, and sometimes people, if they've been, the older folks that might've been in a company for a while and have a large 401k, it's not uncommon for people to take money out of that, put it in a self-directed IRA to invest in real estate. Well, they can do the exact same thing for investing in private companies.
Right, exactly. So they can have an IRA, they can go into self-directed status where they can manage the investment as long as it's passive, right? As long as the investments are passive, then they could allocate those to invest in privately held businesses. And I think there's 2 ways they could do that, right? Generally, there's 2 ways they could do that. One way is they can loan money from their self-directed IRA as a loan to that business or that business owner. And then the other way is the IRA would own shares of this new entity. Exactly.
And it's why I compare it and trying to, when you're bringing new investors into the marketplace, and it's a completely different kind of beast to invest in a private company than what they would have experienced in a public company, the transparency issues. And then within real estate, in that real estate is very objective. It's very kind of like, here's a checklist of what creates the value. And it's not as tangible in a private company, depending on where they are in their stage. So it's another asset class, but you use those same skill sets if you're a savvy public investor that runs your own portfolio on an E-Trade or something, or you have real estate holdings. Is a very similar process and mental process that you go through, where you're looking at, like, if your structure is such that I don't want it to sit for 10 years. Kind of like I like compare it to real estate. If you're gonna, you're gonna get something that's going to create income, annual, monthly income, or an annual quarterly income, or or you're going to invest in something that you're going to hold for a while because you believe that there's a lot going to happen in this area and it's going to really expand the value of that piece of property that I I have invested in. And, whatever the case may be, or, like flips. A lot of
Yeah.
people get started in real estate doing flips. Well, all of that kind of money strategy or outcomes are available in the private equity market for investing in entrepreneurs. Once you understand the way folks like the lender, I have a chapter in the book that's called "When is an Investor Like a
Yeah.
Bank?" And it
Yeah.
goes through some of those ways that a lot of times people will get started when they're uncomfortable with the idea of their money being locked up for 10 years.
Yeah.
And so I like to, compare it. It's not gambling, but if you think about one of the strategies people have when they're playing the tables in Vegas or something, is that they like to get their money back. They get a win and then they try to let it ride on the house, right?
Yeah.
And so that's the way you can do when you start in some of these more liquid ways to be able to, build a portfolio that's specifically dedicated to investing in entrepreneur endeavors.
Yeah, I love it. Yeah, definitely. So let's just say, for example, right now I was in the process of like looking for a private company to invest in. What are some key things you'd want me to understand before I get into this investment?
First, you have to have a personal decision of how much and how you're going to invest based on your liquidity and risk tolerance.
Uh-huh.
So you need to know, like some people will get started, execs in companies and stuff, and they'll just take their bonuses that they
Yeah.
get and they'll put that in, and they kind of have a prediction of that. Sometimes people will accumulate some money, or they'll just get, they'll just cut back if they're going to do the 500 a month kind of a thing. So you figure out how much, because you want to have a strategy that allows you over a period of 5 years to invest in really 10
Mm-hmm.
companies, at
Yeah.
least 10 companies if you're doing larger investments, smaller investments, more companies, right? And so, you figure that out. And that sometimes will dictate the type of company that you invest in,
Mm-hmm.
because if you're going to spread it out and you say you've got access, you think you'll have access over the next 5 years to $30,000 that you might want to put in this. Well, some people that's one investment. Other people that might be 10, $3,000
Yeah.
investments, right? So then if you're only making a $3,000 investment, then that's immediately going to dictate the type of company that you're going to be investing in, right? And so you got to figure that out. And then you figure out, what do you know? Either because of your job or your hobbies or part of your education thing, you have a knowledge of certain industries or certain types of things in the marketplace, or you have a passion for something. Sometimes people are very passionate about the environment. They may be very passionate about women's issues, or, they may be very passionate about certain healthcare issues, right? So what are you passionate about? And then you start to look for, you kind of create this is my thing. I'm going to find a medical company. I'm going to
Yeah.
find a consumer products company that does this. I'm going to do this thing. I want to invest in a woman owner,
Yeah.
whatever. You kind of create your goal of what you're going to look to invest in. And then I recommend not invest once you make the decision to become an angel investor, right? After you've bought my book, because it does have the resource portal that has some of these tools. It has a tool to help you go through and create that kind of thing, and actually to judge the thing, because it's really easy to make emotional investments. You love this particular product or this particular video or this particular entrepreneur, and sometimes it'll cloud your judgment on the other things that may affect that company's ability to succeed. So you want to make sure that you don't make it an emotional decision. Now, ultimately, when it comes down to so you say you get 3 or 4, you go to some virtual pitch events, you go to some of these platforms that have the companies that are raising capital, and you say, okay, I'm going to look at all the companies that are solving XYZ problem or doing this thing. I love to sail. So what's something that's new in the sailboat world or something like that? Whatever about, right? I'm a runner and I want whatever, So you look for products like that, and then you kind of rank them in your own preference on them. And then or companies that are doing that. And then I would step back and make sure you go through their materials, but look at it, particularly if they're on a platform, how easy it is for them to raise their money. It's a real litmus test of their ability to attract the capital and also the customers, because almost every company is going to need another round. And there isn't, so many times people have this FOMO, fear of missing out. and they're like, oh, but this company is so good. Or, oh, if I invest in this one, I might miss this other one that is going to be even better 3 months from now. And, and so that's where the taking the emotion out of it becomes really important.
Yeah.
So that if it fits a criteria, you want liquidity. So you want it to be a convertible, you want it to be a royalty financing model,
Yeah.
or whatever you figured out in that process. And then, take a breather,
Yeah.
watch the company for a month if you feel like you're ready, and then decide about investing in that company and adhering to the amount. And when it comes down to two, then you let emotion pick you, right? Don't pick one on emotion. Get your 3 or 4 that you're thinking about, and then pick the one out of the 3 and 4 that have met all your other criteria that you really like, or the 2 that you really like. And whatever your budget is for that year, what you're going to put into it, or that month, whatever that's going to be. So diversification is the strategy, not only of industry, but also type of investment and stage of investment, early stage to mid stage. And now you get opportunities to go into some of these companies that have millions of dollars in revenue that are raising money under a Reg A plus.
Mm-hmm.
And you can really look at their track record and what they're going to do. So it's significantly less risky than somebody that might only have $100,000 in revenue, let's say.
Right. And Reg A plus, that's one of the regulations, right, that came about out of the Jobs Act.
Yeah. So yeah, there's 4 equity ways, and then the reward based ways for raising company money as what we call a direct public offering. And Reg A plus is probably the most sophisticated of them, in that the companies have to file financial paperwork, audited financials with the SEC, that is the caliber of a public company. That's really the only real requirement they have in that, other than, all the normal disclosure and transparencies and that kind of stuff. But and so that is one thing, because the financial history is going to be valid. I recommend, when I work with investors and with companies that are in that kind of a strategy, you need to make sure that they've got some of the other pieces and parts that you would see of a company. So there's, industry reports and competitive analysis, and, a legal review to make sure that there's not some lurking lawsuit in the side.
Yeah.
And a regular, besides that kind of an accounting review, yeah, they have been paying payroll taxes. And, some of those things that could derail your investment if they haven't done the work to really show how clean they are and how prepared they are for your capital on that side of the equation. That's the piece. And then you got 506C,
Yeah.
which is a trigger out of the traditional Reg D 506. They put it into a B and a C now. Oh, I should say a Reg A plus. They can raise money on a national basis, accredited and unaccredited. Usually the unaccrediteds go into a special purpose LLC, so that they vote as one block instead of having lots of little votes. And they can raise up to $75 million.
Oh, okay.
Okay. 506C, the investors have to prove that they're an accredited investor. And there's a couple of ways that they do that. It's submit like you would for getting financing on a house. Here's your tax returns and your assets, right? Or you can get a balance sheet. The ones that most painful, that most traditional investors have heartburn with, is disclosing all of their assets. They don't like that. And so you can get your accountant or your financial planner or your lawyer to write a letter that says you're an accredited investor. And because they're licensed,
they have to write their license number on that form.
So that's a way to show that you're an accredited investor. And they can raise unlimited amounts from just accredited investors on that. And then, but you can only do that. You can't flip back and do a 506B, which is your traditional private placement memorandum that goes through traditional angel investors. And then there's Reg CF, which is the real crowdfunding.
Yeah.
And that has been, you have to go through, those companies have to go through a broker, a FINRA licensed platform that has a broker dealer behind it. The other ones aren't required to have a broker dealer. It's, a good idea, but it's not required. This one, it does. So the idea is that they knew they were going to have the smaller investors in those, because it started out being just $1 million. They have expanded it to $5 million now, and the SEC has. And so they wanted to make sure, because, what I said earlier, accredited investors are assumed to have a certain sophistication and knowledge,
Hmm.
where they were assuming that these newer type investors, these smaller investors, may not have the same level of sophistication. So they put the burden on the portal to make sure that company wasn't committing
Yeah.
fraud, that they had, sound financials and all the other kinds of stuff. And those portals file the paperwork and keep everything together. And in that case, if the company can't raise their minimum bar of money, they don't get any of the money, and you get your money back. Because and then the last one is interstate, which they converted the Reg D 504. And so every state has some version of this. Some of them
Yeah.
do them well, some of them don't do it so well. You need to check in your state, but it's where the company located in that state or headquartered in that state can raise money, accredited or unaccredited, from investors in that state. And it's a really good economic development model for communities to embrace. So, that would be the thing. And so one of the big number ones that I have for companies, particularly this is for folks that are getting started, when you are making that decision, sort of the emotional part of it and not being emotional, how much money is that company going to need to get all the way to their finish line of when there would be a liquidity event, which is usually an acquisition? So how much are they raising now? And so that's one of the things I like about the Reg CF. It's frustrating to entrepreneurs, but it's a really good litmus test, because if they can't raise that $500,000 they need to get that product fully out to market and their customers and revenues flowing, well, guess what? They're not going to be able to raise the 5 million they need to become a 25, 30, $40 million company that's going to get bought.
Yeah.
Right. And so it's a test on that. And then the reward base, other investors, the ones that aren't afraid of crowdfunding investors, particularly on the West Coast, they love reward-based crowdfunding and even Reg CF, because they see it as a risk mitigation, because that shows that that company knows how to talk about their offering, talk about their product, and get interest and convert that interest to either into customers or into investors. And so to them, that is a great litmus test on whether they can come in and have the money that they're going to put in on top of that, be used properly for accelerating the growth of the company.
And then as far as litmus tests, let's just say, for example, you have a startup, you needed $500,000 just to get the ball rolling with the company, like just to do the initial steps of the company. What is, I guess, the smallest way to do that from a regulatory perspective, in a way where no regulations are needed? Or does that make sense? Like, there aren't any legal requirements, like the most amount of capital you can raise before you get to those stages where you have to go through those compliant matters?
Well, probably interstate. Okay, because with interstate, there's, at least in Georgia, I can speak to Georgia specifically, but there's like one piece of paperwork that you file with the state. And then you still need to have an offering memorandum, but that's where it really works well for okay, so say you're a restaurant owner or you're some small business owner and you want to franchise your concept. Well, and it's going to take $2 million.
Yeah.
Okay, to do that. Well, you can go to your customers.
Yeah.
You can go to the chamber. You can go to the people in your church or your synagogue. Yeah. Right? You can go to any community that you have, your alumni association, your sorority or fraternity that you are a part of. And you can, in that case, if they're in that state, right? And you can solicit to them to bring the money in. And you need to be transparent and truthful, because if you lie, then, eventually you're going to get caught and you're going to, go to jail for fraud. But, you have to do that. But there's really not a lot of oversight on that, as long as you're, in the lanes, you're operating in the lanes. And the thing about a direct public offering, all that stuff, that means you can advertise it to people. You can send emails out. You could put it up just like you see on Facebook with GoFundMe. Now, I don't recommend raising capital on Facebook, but, you can, create a momentum. You could buy a list of all of the high net worth people in a certain zip code in your community and invite them to a seminar that you're having at your restaurant or like whatever it is, or at the chamber. You could there's all kinds of ways that you can reach out to targeted investors in your community to, because that would have it, they may not be sophisticated angel investors, so the whole approach is different because you're talking about the economic impact. Oh, if I launch, I have 3 of these whatever locations, if I create this franchise, I'm going to have the headquarters here, I'm going to have my IT here, I'm going to have my trading here, I'm going to create 30 jobs in the first year, and by 5 years I'm going to have 100 new jobs of well-paying in this community, and you're going to have the additional tax revenue from me being this bigger company that's not just these 3 restaurants or whatever, these hair salons or something, you're going to have this. And so that becomes something where the local leaders in the marketplace go, oh, I like that, we want you to create those jobs in our community, we'll help you raise that capital, we'll help you, we'll host your event, that kind of thing. So to me, that's like it's probably one of the best kept secrets on this stuff. I mean, in the state of Georgia, it came out before the Jobs Act. So beginning of 2012, Georgia and Kansas were the first ones to do interstate. I think there might only be, maybe 30 companies that have raised money under that here. Oh, wow. Right. It's just, it wasn't well advertised. I mean, the government isn't very good at, they're not marketing. Right. So, it word of mouth and, and there were some people early on, but the rest of the crowdfunding stuff wasn't going yet. So it kind of got lost in the shuffle. And then, I have one lawyer I work with here who's got it down to a science. Now, she probably has 30 companies she's helped do that. I should go back and check with her because she really knows how to put it out there and get it to within the network, broker dealer. So to get it, or a licensed person. So she's also able to get it out there. But there's, that's really to me, the easiest way and the least complicated way, particularly if you're a local business. You manufacture offshore, and now because of supply chain issues and tariffs and all this kind of stuff, you're trying to figure out how to bring it back in. And so you're going to buy a building, which you can get an SBA loan for. You already got revenues, but you need to hire up people to run that manufacturing, or you're going to do some robotics and you need IT people. You need additional sales people. Maybe you're expanding in different channels. Well, that's a great hybrid for local investors and the banking community to support that business, because it's going to have such a strong impact on that community when they are able to bring that manufacturing offshore and back into their community.
Yeah, that's very helpful. And this is where like compassionate capitalist comes in, right? Like your brand is that it goes beyond just an investment, but also you're bringing jobs, you are bringing revenue to your local city or county. So yeah, these are definitely, it brings it down to the you and me level. It doesn't just keep it at the Fortune 500 level and large companies. It brings it down to help smaller companies both raise capital as well as, from the investor standpoint, invest in these companies that could have a much higher potential than investing in the stock market. Karen, I want to ask you, is there like an exchange that people can go to see like a list of companies that are raising capital and they could review their offerings on like a single platform? Does that exist?
No, there is not a single platform. There's probably 100 platforms, right? Okay. So, I mean, there's ones like the Seed Invest is probably one of the most famous for Reg CF, and I think they do 506C. Some places like, and then there's Micro Invest that does the Reg CF and the things, but they also do a unique thing where, and I've had some of my investors will say, hey, they do the early stage, but then they'll go to a later stage that's almost public, right? Yeah. So it's going to, they haven't yet filed their paperwork, but people that are in the company can sell some of their stock privately because they've held it more than 2 years, and then they can put it out. Or when companies are doing Reg A plus, you can put out the current investors are able to sell their stocks on these exchanges, and then participate in what. And so when an investor gets in on that, on like in a micro invest, they have the ability, it's not going to be your 2-3x the number, but you're going to go into it as a public stock that you have bought at a discount. So you may get a 10% bump or a 20% bump on that, but you're still getting it before it has it, where you're in the frenzy of a new IPO and the stock rises really fast and then it falls, right? And if your timing on that, is such, you still got it before those people got it, right? So you still got a better deal on it. So, and so that's one of those things. So you have to look around. Sometimes there's ones that are specific to types of companies. Look at their success rate of raising capital for companies as any of these portals. I was going to say Florida, for example, they did a thing. And reason why Florida has so much angel investor activity compared to like Georgia and anywhere else in the Southeast, that people don't really think of Florida as being a hotbed, because there's not one place like at Silicon Valley. It's like spread out all over the state. Yeah. And the state government many years ago started this Florida Nexus or Nexus Florida thing, that was every deal that the angel investor groups were investing in, they would put it up on this portal, and that way anybody around the state could then go in and co-invest in that. And you had your snowbirds coming down from the north, the north in the winter times, and they would participate in those deals as well while they were down there. And then that has since, the government in its infinite wisdom pulled the funding on that, but it got picked up by a venture capital firm that runs it now. So I think that they might have changed the name, but it's still down there. So there are some of those, and some of the states that recognize it as an economic opportunity. I think Indiana might have something like that. Ohio might have something like that. So some of the states will do that, or some of the universities might, have a listing. You can find them in your state if it exists, if you want to look at the ones that are in your state.
And what are the best resources for people to learn more about either raising capital as business owners or investing into privately held businesses?
Well, I would say listen to the Compassionate Capitalist Show, my podcast, because that's what we talk about, is best practices for scaling a company and for investing in those companies to ensure you can get to an exit and produce the return on that. I also have an email series of videos that is called the Compassionate Capitalist Coffee Break. It's just a little snippet of information where I answer questions that entrepreneurs have given me in about a 1 to 2 minute video about raising capital and investing. Sometimes, how do you find the value proposition, things like that. And then, of course, my book, Inside Secrets to Angel Investing, is a primer of how to get started as an angel investor. I've had a lot of entrepreneurs read it to learn how investors think and learn kind of the best practices. Since I'm telling investors, this is the best practices for you to decide yes or no on companies. And these are the kind of questions you're going to want to have asked. And this is where you find companies, things like that. And so sometimes entrepreneurs want that kind of information too, although it isn't written to that as an audience. And beyond that, I would say there's a lot. There's an organization called TEN, capital TEN, which is run by Hall Martin. He puts out really excellent podcasts and has a real good library of content. It's a mixture of angel investor and entrepreneurs. So it's really an angel investor network, but he showcases entrepreneurs to his network, and he puts that out on a regular basis. The Kauffman Foundation has some information up on their website. They mostly provide it to traditional angel groups, but they've started providing some to regular folks that are not part of an angel investor group, to move that ball forward. A lot of the panels, there's an organization called TIE. It used to be I think officially it's the Indus Entrepreneur Network, but now they kind of go by innovation because they're not just Asian Indians anymore. It's really a very diverse organization, and they do workshops on the Thai Globe. I mean, it's amazing the workshops that they do on everything from figuring out valuation, hiring, building a board, how to prepare for exits. Thai Atlanta, which I'm a part of, they have a great all of their content is available. They record everyone, they live stream everyone, and it's all available really for members, which is not very much. It's like maybe $100 a year to be a member there, and you get access to the global network. So I get an email, and if all I wanted to do was watch webinars and learn all day long, I could probably do that on the global webinars that they have all the time. So it's really that's a really great organization, and they're very committed to growing and helping entrepreneurs succeed, and giving them the tools to do that, and cultivating angels to be more active angels. A lot of the chapters have their own angel groups and stuff as well. So
Well, it was a pleasure interviewing Karen. I really enjoyed our conversation and having you on the podcast. I'll add in all the links you mentioned. I'll add in your website, KarenRands.co, in the show notes below, so that way listeners can just click. I'll also add your LinkedIn profile. It was a pleasure interviewing you, and I'm looking forward to having you back on the podcast.
thank you so much. Likewise, we should probably revisit our original one where I interviewed you.
Sounds good. Thank you.
Thank you so very much.
To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN, assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.